Hi, this is Russ Squire again with 1031 Property Exchange, and we are going to go into 1031 exchanges for accountants and tax preparers part 4. And this is without a doubt my favorite section because it gets into the real tips and tricks you can use with clients in order to help them gain greater benefits from their exchanges. So let's get on with the presentation. 1031 exchange client super tips. I'm going to go through a list. One, using the lease option to avoid dealer status that forces full-time developers to pay ordinary income tax on gains. I call that the part-time developer strategy. Two, buying a vacation home in paradise tax-free using 1031 and or 1034 exchanges. I call that the paradise strategy. Number three, take cash out tax-free from your 1031 exchange. Call this the tax-free cash out strategy. Number four, building your dream home using 1031 exchange and 1034 rollovers. Call that the dream home strategy. Number five, buying your kids a home tax-free, renting it to them at 20% below market and converting it later to a personal residence. I call that the sweetheart strategy. Number six, how to save big bucks by turning a build-to-suit exchange into a delayed exchange. I call that the home builder strategy. And number seven, the conservation buyer strategy, using 1031 exchange in conjunction with conservation easements. Call that the ranch buyer strategy. So let's take a look at each of these individually. And these tips, these are pure gold for accountants. If you ever remember to do anything, come back to this. And when you're discussing property with your clients, you can use this as a reference source. But these are just great tactical strategies for people to use. So away we go. Tax-free cash out from the exchange. So, this is really basic. You can't take cash out during the exchange, but, refinance the relinquished property, the one you're selling, prior to the exchange and take out cash and then roll all the remaining net selling price into replacement property, or refinance the replacement property after the 1031 exchange is completed and take out cash without having to pay taxes. The big warning here is, taking cash out during the exchange creates a taxable event or taxable boot. But these are legal techniques that give you protection for the exchange under the IRS safe harbor rules. Strategy number two, buying a vacation home in paradise tax-free. You can use a 1031 rollover to buy a unique vacation property or dream home. Then you have to attempt, the key word here being attempt, to rent or place it with a property manager. Use it no more than 2 weeks a year for the first year or two, preferably the first 2 years so you meet that holding time frame. You can also use up to 2 weeks a year for marketing and maintenance visits, but you want to be careful with this one because the IRS does audit utility records and make sure this is not abused. So you want to get a letter from a realtor or property manager that can help document those additional visits. Somebody could use it for up to a maximum of about 4 weeks a year. You want to file 2 Schedule E and 2 4562 attachments on the property, so you want to have at least 2 tax filings from the date at which you acquired the property. And then you can convert the property in the second year to a personal residence tax-free. You can then bring in equity on your primary residence using a primary residence exemption or a 1034 rollover, bringing that dream home debt down to 0. Then convert the home in paradise to your primary residence. So it's a strategy people use. We see it quite a bit. But it's a way to help clients meet their goals. Using the lease option to avoid dealer status. Now, there was a Supreme Court decision in 1966, William Mallet versus Riddle, and what the Supreme Court found here was that to be a dealer, your first purpose, your chief, principal, primary, and only purpose must be to sell. Now, the lease option, by properly structuring a lease option, you avoid dealer status, and they're the single best way to avoid dealer status in a selling situation. And avoiding dealer status allows the seller to do a 1031 exchange. Now, the option agreement should make reference to the lease, but the lease should not make reference to the option agreement. And the lease should be for at least 2 years. So once again, you're going to be meeting that 2-year holding requirement with 2 years proof that the property is for rental purposes. And finally, in conclusion, the lease options can help developers who do not develop as a primary form of business sell developed property and avoid dealer status. The downside is the 1 to 2 year holding requirement under a lease arrangement. The upside is you avoid the tax. strategy, the sweetheart strategy. And I really like this one because there's a lot of baby boomers that have kids that are now having kids, and gives them an option. A lot of kids nowadays, the economy being as difficult as it's been over the last decade, have a real hard time saving up money for a down payment. And so this is a way to do that. So you buy a second home with a 1031 rollover that's near your children and grandchildren. You then rent it to one of your children for up to 20% below market rents. Then what can happen is grandma and grandpa can even gift up to $14,000 per year per child, grandchild, daughter-in-law, son-in-law, to use as they see fit. In other words, to pay the rent of the mortgage or to save up a down payment of their own for their own home. Grandma and grandpa can visit, live in the property. Obviously they're guests, but the property's being leased by the kids. So, the IRS isn't keeping score on that type of situation because the property is leased. Convert the property after 2 years of renting it to the kids into a personal residence tax-free. If grandma and grandpa decide to make the property a personal residence, they could sell their previous primary residence and use a 1034 rollover to reduce the debt on the new residence to zero. Another option is at the end of the 2 years, there's nothing preventing them, once they've converted it to a primary residence, to selling it to their own kids. So a lot of different angles on this one, but for the most part, it's a way to help the next generation. Okay, combining 1031 exchange with a 1034 rollover to construct a move-up home. Basically, client owns an existing home, has 100% equity, and a rental property with 50% equity. So what do? Well, first year they sell the rental property and use a 1031 exchange to acquire raw land for a dream home. Now in year 2 they could do base improvements, or they could even do it in year 1 if they're doing the exchange. Try to get those improvements in within the 180-day exchange period, and improve by adding a road, maybe electric, gas, and sanitary. So that could all happen all of it in year 1. Just depends how many exchange dollars or exchange debt that they have to meet in order to make the exchange fully non-taxable. In the 3rd year, on the 2nd anniversary of the rental property sale, they can begin the construction of that dream home, convert the land to personal use tax-free, and list the primary residence that they have now using a 1034 exemption to pay off the construction loan for the new primary residence. So it's a way to build a move-up home and try and make it as least taxing as possible. Builder's delight. So a lot of builders do build-to-suit exchanges periodically. They're expensive, and there can be a lot of problems, as we'll see. But builders attempting to complete an IRC 1031 exchange, having sold a rental property, and is now trying to construct a new rental home on raw land within the 180-day total exchange period. Builder has nightmares over doing another build-to-suit exchange. They're experienced with it, and what they had an exchange intermediary that was slow dispersing funds to satisfy the builder's vendors. And as anybody who's been in the building industry knows, the subcontractors and vendors are your lifeblood, and you don't pay them, they don't show. So plus that exchange also cost the builder $6,000, because build-to-suit exchanges, as I mentioned before, are expensive. There's a lot of accounting that goes on with build-to-suit exchanges. Well, we've got the builder refinances the property they are selling. This is the relinquished property prior to its sale, and they take out the equity necessary to complete the improvements on the property they're building tax-free. Then the builder controls all the money necessary to complete the improvements instead of the qualified intermediary, so there are no vendor issues. Then the builder completes the new structure within the 180-day exchange period. Builder saves himself over $5,000 in exchange fees, because it's now just a standard delayed exchange. And basically, as their CPA suggests the strategy, and it adds a lot of value. So conservation buyer strategy, land costs, especially here in resort areas in the Mountain West, just don't pencil anymore for traditional farm economy or farm and ranch use. So, and large ranch buyers have become oftentimes the economic elite, with quite different goals from the original mainstream ranch establishments. So buyers often interested in conservation, fish and game, preserve management, enhancement, solitude, never really has any intention of developing the property. So by combining a 1031 exchange to purchase the property with the tax benefits of a conservation easement, this can allow that buyer to acquire a large ranch for a fraction of the cost of the listing price out of pocket. So combining conservation easements with 1031 exchanges is a good way to acquire larger tracts of land or larger properties. So in part 5, we'll discuss property reinvestment decisions and risk. If you need to talk to us directly, want a free consultation, or would like to ask some questions, you're certainly welcome to call us. All our contact information is listed here. So once again, this is Russ Squire from 1031 Property Exchange.